President Trump spoke at the Economic Club of New York last Tuesday, and he took the opportunity to repeat his call for the Federal Reserve to keep its foot on the gas.
Because remember, we are actively competing with nations who openly cut interest rates, so that now many are actually getting paid when they pay off their loan, known as negative interest. Who ever heard of such a thing? Give me some of that. Give me some of that money. I want some of that money.
Are negative interest rates really that negative? That's the title of a recent note by Dr. Christopher Smart, Chief Global Strategist and head of the Barings Investment Institute. He joins us now from Boston, Massachusetts. Not sure if the president has read your note, but there is sort of this broad view by economists that negative interest rates, or certainly by market participants, that they're not necessarily a good thing. But in your note, there's sort of more nuance there.
Well, I think there's a lot of nuance in the market right now because on the one hand, we've come off of this huge injection of liquidity in the wake of the global financial crisis. So there's a lot of money sloshing around out there. We're in a world where returns are low, inflation is low, and central banks just don't have the same tools at their disposal that they used to have. And so they're in many cases being forced into slightly negative territory. And I think it's really too soon to offer a final judgment, but at least in the initial phases, we have some evidence where that it has led to some credit growth. And at least you could make the clear case that had rates not fallen this far, had they not gone negative, our cycle would have ended, months, if not years ago.
I may have misread what you wrote, and help us understand, help me get it right. Was this, drive toward negative interest rates a direct result because of the financial collapse of 2008, or were the wheels already in motion taking us where we are now headed?
I think it's some of both. I think we happen to have this very large crisis, historic crisis. Central banks responded in the only way they really could. But then as they started to dial back the stimulus, I think they realized that these broader forces you just mentioned that had been building for some time were very much in play. Globalization, which keeps price inflation low, demographic trends, which has put a dampener on a lot of our spending patterns, and technology, which also is driving very important changes in business models. So all of these things kind of hit at once. And so we are in a world with lower growth, lower interest rates, and therefore fewer tools at the disposal of central banks, when at the same time, fiscal authorities, governments, have been reluctant to spend more at this stage in the cycle. So that's why they have been driven into negative territory. The longer-term question, is if we are in negative territory for a long period of time, what kind of distortions does that create? But at least for now, it seems to be the right choice.
Christopher, here's a basic question, interest rates for dummies, if you will. So when Trump talks about negative rates in other countries, my understanding is negative rates in places like Japan and parts of Europe are there because those economies are weak. I mean, and they have structural problems. It's not as if that's a great thing. It really reflects something that we don't want to have here in the United States. Isn't that correct?
Well, I think that's why we don't have negative interest rates in the United States. Our economy is much stronger. The concern, of course, is if you are headed into a world of much lower growth, falling prices, then the whole world could be dragged into a deflationary spiral. And that is something that everybody wants to avoid at all costs. I think the case in Europe, the case in Japan, at least where there are less opportunities to raise money outside the banking system, you really have to push financial capital through banks. And at least right now, the only tools at the disposal of central banks in Europe and Japan are to tilt rates slightly negative. So it's a reflection, as you say, of weaker economies there. We're not there yet. We are not there yet in the U.S. But with that as the only tools that those banks have, it's certainly better than the alternative. They don't want them raising rates into an environment like this.
All right, Dr. Smart, we have to leave it there. Dr. Christopher Smart is Chief Global Strategist and head of the Barings Investment Institute. Thank you.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.